Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter. I asked the question on Twitter. It's right here. What are some questions you have about the markets? And I'll dive into a bunch of different questions, answer it with my opinion. This is very similar to what we do with the Platinum question and answer session, except it's real time back and forth discussion on the finding-value.com Platinum membership. So let's dive in here. Let's hit some of the questions up, and I'll give you my opinions here. So let me zoom in a little bit here, get you a little bit easier to see. So OIH versus XOP. Someone says, will oil services outperform the exploration and production companies? My opinion is yes. We've been talking a lot about both of these in this. Now, it doesn't mean that oil services, that all of those companies will outperform all of the exploration production companies. I think if you're selective, you want to select companies in both areas, oil service and also exploration and production. So I think that there's very good investments in either one of those. E&Ps in general have had a little bit larger run than the oil service companies. So there's some really good deals over in oil service, and there's also good deals in exploration and production companies. So it's not a clear yes and no, but if you're going to do an ETF, then oil services is a much better value there, especially when you do a ratio comparison. And I'm going to do those ratio comparisons of OIH and put them on the website for platinum and or silver members to view. So I'll update that here shortly. How much longer might we have to wait for a substantial move in the junior silver miner equities? Will any hydrogen associated tickers finally take off since we saw a descending hydrogen UR wedge in that subsector? Well, I mean, what I look for is I do ratio analysis. So let me pull up a chart just to kind of show you guys what I do and kind of what I'm looking for. Is you said hydrogen, HYDR, and if you can see, that's not it, HYDR. I'm looking for the Global X Hydrogen ETF. And if you look at the Global Hydrogen ETF, you can see that we've got a falling wedge. We've broken to the upside, and now we're kind of falling back down, and we've got some real nice bullish engulfings down here. There's two of them. This looks really good. It's probably potentially could bottom. The only thing that I don't like about this is when we look at this, we've broken through that low. This isn't a higher low. This is a lower low. But again, it could be a false kind of breakdown to the downside. So it does violate that stance. Usually what I like to see is a higher low and then a higher high, and that validates that we're in an uptrend. But this one has a lower low. That's the only thing I don't like about it. But there's a lot of whatever ratios you look, HYDR does look, I'll just say, interesting. I do think energy service companies are probably a better bet. And we've been going over a lot of the energy service companies on the website a lot, especially during the Platinum members. And we got some very big returns in the short term there. I'm not doing anything. I'm just riding it higher if you guys are listening to this, which hopefully you are. And I still think those are really good opportunities. I just don't know if you can go up 100% plus in a month or two and not have a pullback after that. Is the Texas WTI gas really went under zero? No. Well, not the gas in WTI. I think what you mean is over TTF Dutch natural gas went below zero. But that's because of storage issues. And I think that could easily swing to the other direction just as quickly. Is a market liquidity crash coming? What do you think? Is inflation transitory, as in under 3-4% long-term this decade? Do sovereign debts really matter, as all central banks are raising rates as if it's not a problem at all? So is yield curve control even a possibility there? Good questions. So is the market liquidity crash coming? Well, the market isn't very liquid. That's why you're seeing yields rocketing higher. But we're seeing that money come back into the bond market because of poor earnings in the tech sector. So we're seeing a lot of pressure build in the tech sector from increasing interest rates. Will they bring liquidity to the market to do some sort of yield curve control? I don't have that answer for you. I wish I knew exactly when they would stop raising and all that other stuff, but we don't. And we'll have to get our cues from Jerome Powell. And is inflation transitory, as in under 3-4% long term this decade? I think the answer is going to be maybe, and I'm gonna kind of go into why I think that. And there's two forces that basically drive inflation. One is the money supply, and the money supply is heavily dependent on interest rates. It's heavily dependent on loaning in the system. And if your loaning slows down, your M2 growth rate, which is in the black here, also goes down. And we've come all the way back down this, and the red inflation line is lagged behind the M2 money supply line. So I say yes and no, because it depends on interest rates. It depends how many loans we put in the system. CPI is also a measurement of how bad the energy market is messed up in terms of an energy crisis. So all of those things matter. We saw lots of money come into the system, but we also saw an energy crisis over in Europe, and we saw those consumer price index numbers, inflation, the way they measure it, go up dramatically. So it's a function of how much money's in the system and how that money gets translated into the consumer price index number. And right now, we've got a lot of money in the system, and we have energy constraints, especially in certain areas of the world. So it depends on how bad those constraints get, and it depends on the money supply, and that we can watch both of those kind of separately. Which should we buy now, oil producers or oil services? Well, I'm going to put all that information on the website, finding-value.com. I'll put all of those charts on there. For silver and for platinum members, they're all ratio charts with ETFs. You guys can see and see for yourself what it looks like. I've also, we've been looking at a lot of energy service companies with a lot of leverage to the oil service move. So there's a lot of companies that we've been buying, and I think they're incredibly good deal. Some oil producers I think are also very good. And I think that the oil service companies, if you look at the ETFs, do provide better value. And they look very good from the ratio perspective. Video on most least likely and best worst case outcomes for the next 3 to 10 years. Your vibe lately seems to be more somber regarding currency crisis, almost as if you think it's the most likely and how painful it will be. Is the world going to go full Weimar? I don't know if it's going to go full Weimar, but currency, a lot of pressure is going to build in the bond markets, which then builds in the currencies. But it also depends on how earnings go and what they want to do, they being the Federal Reserve. If they want to bomb the currency, then they'll save the bond market. And your currency gets hit, because that's where the pressure then mounts. And these pressures just don't go away. It also depends on how persistent the energy problem is and how long that lasts. So if it's persistent and it lasts the last time and it's intense, then yeah, I think currencies are going to become less valuable. That is inflation. You're going to see prices of products go up and energy prices go up. And I think we have a condition where all of that can exist all at the same time. Currency crisis and supply chain problems. And then also maybe perhaps money coming into the system from a bond market that doesn't like those market conditions. So they're going to come in there, try to do yield curve control or something like that, and backstop the bond market, which then mounts the pressure in the currencies. What are your odds you give that there's a Fed pivot at the next meeting? You know what? I don't try to play any of that. This is all structural by nature. There is the interest rates do matter for some of these things that we watch. They did pile a bunch of money into the system, but if the pressures are there and it mounts in the bond market, I don't think it matters if they pivot or not. I think those pressures are structural by nature, and they're going to take a long time to solve. So I don't know if that matters as much as what most people think. And I'll just make a couple of comments here. I invest for the long term. I invest for the structural conditions that are messed up in the markets. We can see that through the ratios. We can see where things are cheap, where things are expensive, where the money is at, where it's not, and how it's flowing. So that's what ratios give us. And if we have a good handle on where the money is and isn't, you can kind of be a contrarian and buy the cheap asset. Then you just use time, because if the problems are out there and they're not being fixed, then you just need time for that money to kind of figure out where to rotate. And it'll rotate to the areas that need fixing, where the problems are at, because that's where the money is going to flow from a consumer standpoint. So if consumers are struggling because they're in an energy crisis, it's going to flow towards energy. And then investment money will also flow towards energy to solve it. So the imbalances in the market are more or less is where the money is and isn't, and your market conditions of when those imbalances are realized by humans is when they start to shift and move into different sectors. So you're just kind of sitting there buying the cheap stuff, looking at your inventories draw down, and you're just waiting for the money to rotate at that point. And it's going to happen in commodities, because if we look out in the future, they all have market deficits, all of them. Well, almost all of them, maybe not every single one, but there's a lot that have market deficits. I can name like 10 off the top of my head, like natural gas, oil, tin, copper, nickel, cobalt, graphite, lithium. There's a bunch more, just to name off the top of my head. So, I don't think even with the Fed pivoting, it's not going to solve anything. It's not going to solve that. But increasing interest rates also makes the cost of money more. And that may delay some of these projects that want to come on, that they need to borrow money at very high rates. And maybe that screws up their net present value calculations, and things get messed up, and they have to delay the opening of it, which then delays the supply response of all those different things. But that's why we watch inventories. Inventories are they're basically the leftover of the supply demand. If they're eating through inventories, we're short. We're running deficits. If they're adding to inventories, we're running surpluses. Right now, we're very low in inventory, and we've been eating through inventories on a lot of different commodities. That includes copper, natural gas, oil. And remember, these things are seasonal too. You have to add in the seasonality. It's not just up or down. They're also seasonal, and you have to make sure that you're looking at things from a year-over-year perspective. That goes for real estate and everything else. The reports of the housing crash have me perplexed. Understandably, markets like San Francisco and Phoenix may have peaked, but why do homebuilder ETFs like XHB seem to be building off their recent lows? Yeah, it is perplexing. We do have a larger demographic coming into home buying years, the millennials, and they do need homes. But what happened is these interest rates have shot up dramatically very quickly. I did not think that they would shoot up this fast and that amount. But we are in the home builders ETF. Basically, we're basing out here, and we're getting a nice, good bullish candlestick here where we could go higher. So that is, I think, very interesting, where we could potentially go higher. And why are they basing out if we're at the top? That is a good question, because I don't know if we're at a top. What we're seeing in the markets is we've got this demographic coming to home buying years. It wants to buy a bunch of homes. We saw the inventories drop to very low levels, but that was also mixed in with very low interest rates. Affordability is a function of interest rate times your home price. Home prices, ramped up very dramatically. And at the same time, we had mortgage rates just skyrocket very quickly. And I think it's the markets digesting all this. They, people are trying to digest it, and they're going to have to figure out, are interest rates going to stay high? Are they going to come back down? If they come back down, there's a high probability that buyers are going to come back into the market. So I think the buyers are there. They're just being priced out right now. So when we look at the M2 money supply and all the money that came into the system, that's very inflationary. And when that inflation comes into the system, and we see it in the consumer price index, perhaps it shot the interest rate to a level that is unsustainable. So the inflation in the system is seen through the stimulus money that came in that everybody's spending like mad. That drove inflation to a higher rate than what the rates are normally kind of sustainable rates that the market can sustain. So we might go to levels that are unsustainable, come back down to levels that are more sustainable, and then stay at those more sustainable level where the housing market clears and loans get made into the system in greater quantities. What that level is, I don't know. We'll have to watch it. And that's what I meant by a large inflationary kind of push. We may come into a little bit of a disinflationary environment where it comes back down, and then we get to a more sustainable interest rate and inflation level. And that's where we're trying to figure out, where is it going to level off? Where is it going to stabilize? And I think the home builders they're in the game of moving volume. And yeah, it does impact their profit margins given where home prices are at. But the volumes of loans, that's what we're looking for. Volume of loans is what determines if it's inflationary or not. So that's what we're looking at. And right now, I'm just waiting. It's trying to see the data, see what's coming out. Everyone else is very convinced that we are in a bubble. I mean, they are adamant about bubble, 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 but we don't have inventory levels where they were or already were close to where they were when we had bubbles in the past. So I think what the market's trying to do is digest the interest rates and how quickly they moved up, and are trying to figure out where to go next. The home market's still at very low levels of inventory, but home prices are they're coming off their highs a little bit, but there's also seasonality mixed into this. So it's difficult to get a good read on it. And everyone who's just saying, oh, well, month over month, it's going down. Well, it does that, usually based off of the cyclicality of the season. So you can't, it's really hard to gauge where exactly the market is. I'm in the bull camp, but it could be paused. It could be delayed, much like the mid 2000s. And if we see stresses in the system, in other portions of the system, like the bond market, like the stock market, and they lower rates, that's going to put upward pressure underneath the real estate market. So it's a complex system. It's not, you move one because, we want to slow down the housing market, but we can't go fast enough and high enough to kill all the other markets. So they're going to be playing this balancing act that's very hard to balance. So I think that's what's going on. As the housing market is paused, we're seeing prices kind of come back a little bit, and we're seeing the home builders kind of go sideways. And we're waiting to see, are interest rates going to go down? Are they going to try to save technology companies or the S&P 500? Are we going to save the bond market? Like what's going on here? Are pension funds in problems with the bond market and the interest rates going up that fast and the bond market pricing going down so much? It's a complex situation. I think the Fed's put in a corner, and they're going to have to figure out what they want to do. So that's a complex question. Hopefully that gives you a little bit more to chew on. When is it time for dry bulk to join the bull market? Would be nice with a YouTube on dry bulk, maybe with those guys, ship nerds. I had Nick on, and my opinion on dry bulk is we're super early, and that is a function of volume of commodities, and then it's the interaction of volume and the relationship of the capacity of dry bulk ships. I think that there's going to be a large barrier to entry for new ships to be built. based off labor and supply chain shortages. And I think that the want and need of shipping materials around the world is going to go up. When you look at it from a big long-term perspective, the timing of this, I think, is going to be difficult because what's going to happen is you might get funding from governments to say, go do these renewable energy projects, go do these projects where we want to put up transmission lines for electrical transmission. And there could be other things that drive it as well, in terms of commodities needing to be shipped. And I think that barrier to entry for the supply to respond, I think will be that's what's going to make it a big bull market. We're also at very low levels. We've got cash flows coming out all over the place for dry bulk shipping. So I also think that from a value perspective, it's a great spot to be looking. And I know it's not, a lot of people don't like it right now. I think a lot of people are getting pretty frustrated with it. And that's usually the time to be looking at it. So I'll post a lot of these ratio charts on the website, and you guys can view them. Yeah, I know it's a membership website only, but those who are members, you get to see all these different charts of graphs of the ratios, which I'm going to post here right now, and you guys can take a look at it. And Energy Services looks really good. You guys know the companies I own. There's a lot of big leveraged companies where they move a lot when they go, but we've already had pretty big moves. So I like to buy things when they're down. I do not like to chase. And, I'm getting more questions about Energy Service, which usually means that people are chasing in there. So there's times to buy this stuff. I've been posting, copious amounts on Energy Service companies the past couple of weeks for entry points in a lot of my favorite companies. So you guys know which ones I like, and hopefully you guys positioned however which way you want. Again, I can't give financial advice, but I overweighted the ones. You can see the ones I overweighted. They're on the website, and you can see my portfolio, and the ones that are bolded are the ones that I overweighted. So we'll stop it there. We're about 22 minutes. So obviously, guys, if you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Subscribe to the website if you'd like, the Platinum membership. We do have a Saturday, 7 a.m. Question and answer session. I flip-flop Saturday and Sundays. Sunday at 5 p.m., Saturdays at 7 a.m. So you guys, I get a wide array because there's a lot of people around the world that can or cannot make those times, and it's a large gap. So hopefully you can make it, and if you make it, that's great. So that's all I've got. We'll catch you next time. This is Finding Value.